Okay, concept check 4.2, 5 examples of income that must be included and income reported to the IRS. You actually have 6 here: wages and salaries, commissions, bonuses, tips earned, interest and investment income, retirement income. The concept check 4.2, how are long and short-term capital gains treated differently for income tax purposes? So first off, long-term capital gains are taxed at different levels. I believe if you're making less than $44,000, or some in that neighborhood, you pay no capital gains tax, and like between 44 and 100. I'm not exact on the range, but this is information that's in that tax rate summary. You pay $15,000, and it's different for married and single individuals as well. Anyway, long-term capital gains, anything over a year, anything you've held for over a year is a long-term capital gain. So that goes to 20% if your income reaches a certain level. But long-term gains are taxed at lower capital gains rate, while short-term capital gains, items you've held for a year or less, are taxed as ordinary income using your marginal tax rate. This is one of basically what real estate investing does. Is it, because of the tax treatment, it effectively converts short-term gains to long-term gains. So as a result, even if the value of the property doesn't go up, you benefit due to the tax treatment. So, concept check 4.2, examples of income excluded from IRS reporting: gifts, inherited money or property, life insurance benefits. I mentioned on this, if you have life insurance that is you buy through your employer, and it's your premiums are deducted from your income, then that is taxable. But if you pay for life insurance with after-tax money, this is the case. It's included. Child support payments, scholarships spent on required fees. 3 examples of adjustments to income: IRA contributions, alimony paid, new limitations under the Tax Cuts and Jobs Act, student loan interest paid. Again, IRA contributions if you qualify. Okay, so I mentioned tax credits previously. The health insurance premium tax credit, American Opportunity Tax Credit, and Lifetime Learning Tax Credits. Those are the 2 that I mentioned are for education. Earned Income Tax Credit is benefit provided to lower income individuals with children. Most of these or many of these are for low income individuals, but there's adoption credit, mortgage interest credit. That's another low income. Retirement savings contribution credit, elderly or disabled tax credit. So, I'm sure this is not an exclusive list of tax credits. Again, these are deducted directly from your tax liability. So very, very valuable. All right. Tax avoidance. Practicing legal tax avoidance, not tax evasion. You don't want to break the law, but common strategies, employer options. Reduce your taxable investments, making tax sheltered investments. So you can reduce your taxable income with your employer with a premium only plan. The premium only plan is, as far as I understand it, is pretty much your standard employer health insurance plan. The flexible spending account. So there's flexible spending accounts for healthcare and child care, and then defined contribution retirement plans such as 401ks, 403bs, and 457 plans. 403bs and 457s are the public sector or government sector plans, and matching contributions. One sad thing is like somewhere between 40 and 50% of employees take full advantage of their matching contributions. So that means that over 50% of employees don't take full advantage of their matching contributions. This is free money, so highly recommend taking advantage of it. So next we'll start with reducing taxable investments.